The digital economy is linked to the high development in China, and the digital currency will play a huge role going forward. During 2 sessions this year, China's digital yuan was a much discussed topic, especially after it's piloted since last year. Now I'm in Shanghai, one of the selected locations to pilot the digital yuan. Now let's find out more about it. First up, how to spend it. Before you're getting down to spending, you need to download the digital RMB app or the wallets. And since the currency is still being piloted, you need to have invitation code. Hi, now we are at the Shanghai's Metro Henshan Road railway station. The vending machine behind me accepts the digital RMB. Now let's do the shop. I choose the good first, and on the screen it shows it supports 4 methods of the payment. This is WeChat Pay, Alipay, Union Pay, and also the digital RMB. Now I open my digital RMB wallet and I scan it. Okay, it's quite simple, isn't it? Now, several online platforms also accept the digital yuan. And back in December last year, Jingdong.com became the first e-commerce platform to be selected by the Central Bank of China to trial the digital yuan. Now let's show you how to purchase on Jingdong.com by using the digital currency. All this is good and well, but why China creating a digital currency now? What benefits it bring to the users? And does it mean end to the physical money? I put these questions to the finance expert Hu Jie.
You replace M0, the coins and the paper notes, with digital number. But what matters in the macro policy or monetary policy is how much money you issue. It's how much that matters. It's not what form you issue the money with that matters. So now what we're doing is changing the form of the money, not the amount of money.
The Chinese university professor points out that China is going to replace much of their M0, physical paper notes and cupronickel coins, with their soon-to-be expanded fiat central bank digital currency yuan. The claim is that they are merely changing the form of the monetary unit and not the amount of units issued. But if you believe that, on a long-term scale, that the current Chinese elite are not going to abuse the system or skew the data to near total opacity, well, I have a bridge to sell you.
Coins or paper notes have their roles to play, probably for a very, very long time in the future. This is an amazing technology, the blockchain technology. So everybody is paying attention to it. Is trying to understand what kind of impact this technology may have on the monetary system.
Basically, only older generations in China currently use physical yuan cash notes day to day. So within one generation, one could expect that the Chinese may become one of the first major economies with next to no cash in their economy. Turning our attention to the United States, which is no doubt also working on a full fiat central bank digital currency at the moment, what often many, like myself, call the fiat Fed coin. We have an update on our nation's fiat M0 monetary base supply. We begin the update by looking back to September 2019. The monetary base at the time was just over 3.2 trillion. Now updated through February 2021, it is over 5.4 trillion. And that's a massive increase of over 2.2 trillion in the nation's fiat monetary base, beginning with the New York Fed's repo loan fiasco, which kicked off in September 2019. Here we are, a year and a half later, statistically speaking, and the nation's fiat Federal Reserve note base, or hard M0 monetary count, is up over 70% since not long ago. Hello there. On behalf of SDBullion.com, this is James Anderson for your complimentary SD Bullion market update for the week. Before we go any further, do me a solid and give this video a like. Doing that will help other like-minded bullion stackers and precious metal interested viewers to find our valuable information and content. If you're not subscribed, do that now. Silver and gold had slightly down weeks in spot price performance. The gold-silver ratio blew to the upside and closed the week at 69.25 spot ounces of theoretical silver to get a theoretical spot ounce of gold, whereas the Gold Eagle and Silver Eagle bullion coin sales data ratio on popular auction website sits at 56 currently. Turning back to the Chinese fiat yuan CBDC expansion upcoming ahead, We're going to quickly read through this short article today I found on the Mises Institute. It's entitled Why Beijing Wants a Digital Yuan. It's written by Joseph Solis Mullen. In his 2011 book on Russia, former U.S. Secretary of State Henry Kissinger used the ancient Chinese game of Weiji, or Go, as it is also commonly known, as an extended metaphor to conceptualize and explain the decisions of the Chinese regime in both foreign and domestic policy. A game of strategic domination akin to chess. Go is won by building and maintaining key positions around the board, rather than by any strategy of outright attrition. Understood as one of the stones placed upon the board, the digital yuan joins the Belt and Road Initiative, BRI, the Regional Comprehensive Economic Partnership, RCEP, and militarization of the South China Sea as part of a strategy for squeezing U.S. positions both internationally and domestically. In the struggle to dominate the multidimensional board of geostrategy, space, cyberspace, air, land, and sea, the digital yuan poses a new and unique challenge to the U.S. regime. Though there has long been speculation, even serious discussion of the dollar being replaced or eventually displaced as the world reserve currency, it has remained the overwhelming currency of choice, due in part to institutional inertia, but also because of the continued relative economic predominance maintained by the U.S. As Tim Morrison pointed out in Foreign Policy a little over a year ago, this exorbitant privilege entails many advantages for Washington. Chief among them is the U.S.'s ability to cheaply and immediately finance its own deficit spending, as well as disproportionate power in imposing economic sanctions. Though the most recent burst of COVID-19 related spending in the U.S. has rekindled talk of the demise of the dollar, over 80% of all international settlement transactions continue to be conducted in dollars. As to how the full-scale launch of the digital yuan may undermine this standing point, it provides the Chinese regime two immediate advantages. The first is that in the age of ubiquitous mobile phone services and devices, millions of rural Chinese will gain access to banking services previously unavailable, upping demand and circulation of the yuan, and enhancing the integration of rural Chinese into the larger Chinese economy. Second, unlike cryptocurrencies like Bitcoin, digital yuan is controlled by the Chinese regime and will allow it a clear, real-time picture of the Chinese economy, providing greater ease for the regime to centrally manage and plan its fiscal and monetary policies. Combined with their investments and involvement in Africa and Central Asia via the BRI, the Belt and Road Initiative, it is not difficult to imagine such immediate access to China's legal tender. This is key, as no other digital currency is yet recognized by any state, potentially sending demand for digital yuan soaring across Central Asia and Africa and increasing its use in settling international transactions. Though it had reigned uncontested for a century, it took comparatively little time for the British pound to lose its place as the global reserve currency. In the age of acceleration, the dollar's fall could be even more abrupt and the fall more precipitous. The global financial crisis signaled the end of an economic order. The next iteration of that order is yet to be determined. With the dollar even unseated, it would drastically alter the ability of the U.S. to maintain its present deficits, which show no sign of abating, and which are the foundation of the U.S. fiscal military state. Though arguably still preponderant, Washington's relative economic and geopolitical power continues to decline compared to that of Beijing. The digital yuan is likely to continue this trend. Digitizing the dollar, as Morrison suggested in his foreign policy article, is an obvious necessary countermove from the U.S. regime's perspective to the arrival of the digital yuan. The Trump administration did nothing to that effect, however, and the Biden administration has articulated no clear vision on the future of cryptocurrencies or a digital dollar in the U.S. besides vague indications of coming regulations. There's certainly nothing so sweeping as the digitization of the dollar. For now, this limits Washington's ability to compete with Beijing in terms of seizing the benefits of a regime-approved digital currency. Side notes at the bottom, apart from the threat such a situation poses to the position of the dollar internationally, Beijing's launch of the digital yuan also throws further into question the future of Bitcoin and other existing cryptocurrencies. The majority of Bitcoin mining is done in China. As such, major existing cryptocurrencies themselves opaque to external surveillance and unable to be controlled by the Chinese regime now compete directly with the digital yuan. There exists the threat that China may abruptly follow India in considering banning all other cryptocurrencies. It has, after all, done so in the past and has hinted it may do so again, as corporations and institutional investors in the United States and Europe have in the past year begun taking substantial stakes in some of these cryptocurrencies like Bitcoin and Ether. A sudden shock brought about by Beijing fiat banning those currencies in China could trigger unknown volatility and risk the U.S. and global financial markets as these institutions hemorrhage untold billions. Briefly, we would like to follow up on a video that we had here on this channel about a month ago. The heads of the U.S. Treasury Federal Reserve Meld spoke with members of the Senate this past week, and sparks flew as Louisiana's Senator Kennedy threw shade at U.S. Treasury Secretary Janet Yellen for her and the Biden administration's endorsement of a coming new $1 trillion issuance of fiat IMF SDRs. Have a listen.
Secretary Yellen, the Biden administration's plan, and it is your plan, to require the IMF to issue $1 trillion of these SDRs, new SDRs, is going to cost the American taxpayer about $180 billion. Now, your reason for doing that is a good reason. You say you want to help poor countries. But you and I both know that only about 10% of that money is going to go to poor countries. It's not going to help poor countries. It's going to help if they cash in their SDRs. It's going to help China. It's going to help Russia. It's going to help Venezuela. And besides that, under your plan, you're intentionally splitting the plan into two tranches of $500 billion each to avoid having to come before Congress. And I don't understand why it is efficient to charge the American taxpayer $180 billion, all of which we have to borrow, and you say you're doing it to help poor countries, and only 10% is going to poor countries, and even more is going to Russia and to China.
I'm sorry, it's not going to cost the taxpayer $180 billion.
Sure it is. You're going to have to borrow the money. You don't have the money sitting in a checking account.
The IMF.
They're going to redeem those SDRs, not just the poor countries, but China.
There are many countries that can provide hard currencies in return for SDRs, including the United States. If the United States does agree to provide SDRs, it will have to issue treasury bills or debt to do it, but it will also.
I rest my case.
I'm sorry, but it will also earn interest on any amounts that it converts on behalf of other countries, and it will be essentially a wash.
But the money will never be paid back.
And it will pay. It does. There is no money to be paid back.
Sure.
It doesn't matter. The interest that we earn on any excess SDR holdings offsets the cost of issuing treasuries, and it's essentially a wash, and it is not costly.
I disagree with you, Madam Secretary. I think I'm no disrespect, but I think you're wrong. I think we're going to have to borrow all $180 billion of this.
I don't know where you got a number like that from.
Well, when China comes to redeem its SDRs and says we want dollars, where do you think we're going to get the money? We're going to borrow it. I've gone over. I'm sorry, Mr. Chairman, but this is an important issue. I'll call you, Madam Secretary.
Okay, I'd be glad to talk about it offline.
Thank you. Thank you for your time.
What leadership. Moving on. Comex silver deliveries for the month of March 2021 are now second highest level on record. If you look at the section second from the bottom here on this chart, entitled Cumulative Stopped Contract Deliveries, which would be more accurate if we simply called them Cumulative Stopped Contract Warrant Transfers between traders. Well, over 11,500 Comex silver futures contracts have been settled this month of March 2021 by the transfer of ownership of the underlying fractionally reserved Comex silver warehouse bars. That's nearly 58 million ounces that have swapped title this month. Most importantly, in this almost near completed first quarter of 2021, we have witnessed a large amount of silver bullion withdrawn from the Comex stockpile, much of which likely went to feed the unprecedented silver bullion demand starting with the silver squeeze movement's end of January 2021 inception. So it is working. Remember back to 1 year ago when we had record futures versus London prices for bullion. An arbitrage situation arrived, which sucked a lot of silver and gold bullion from the London system into the Comex system at the time. Then let's think back to the summer of 2020, when the Comex seemingly recklessly ushered in a whole new swath of acceptable gold bullion bar brands into their Comex system. bullion bars from places like China and Russia and Turkey. And Turkey is essentially alleged a blood gold refinery district. The Comex is beginning to rival on paper the Chinese Shanghai Gold Exchange in terms of physical contract warrant title transfers, at least on the gold side. But it remains to be seen how, if, and when we might actually begin to see more rampant pulling of both silver and gold bullion from the questionable, fractionally reserved future exchange that is the Comex. But one thing's for certain, based on the data points that we just went over, they don't add up. The fact that the 4GC contract that they claimed was a reason why all these fractional gold ounces are now underlying the Comex. If we simply go look at that 4GC contract that they created out of thin air for no reason, no one is trading it right now. So this entire spike of gold that's supposedly underlying the Comex facility, I claim it's false. The fact that no one's trading 400-ounce gold bars on the Comex tells me that. It seems to me that they're double counting. We can only infer that the Comex remains desperate to continue to attract bullion bars into its system, so we'll keep monitoring this as it goes along. And to close this week's update, here is a blown-out, detailed look at the last 51 years of silver prices aggregated trading data during New York trading hours. The chart begins on January 5th, 1970 at $1.92 an ounce. And as you can see, it's gone up and down between bear and bull markets for silver. But just over 5 decades of starting price to ending price during the New York trading hours, the silver price has gone from $1.92 per ounce to now 21 cents per ounce. This further confirms my belief that silver is the most criminally traded commodity market globally, one that's quoted as if the spot price is legit price discovery. It boggles the mind. What it shows me is that during interim and secular bear markets, the line slides down on the slope, obviously. And this latest one is getting long in the tooth. You can see it's at the lowest point it's ever been. I mean, the rigging has been exceptional. But the thing is that the physical bullion is running out. As long as people keep silver squeezing and more people keep coming and they keep printing fiat currency out of thin air and just all the things that are lining up in terms of evidence, we're about to start climbing up a new wall. When exactly? Sooner than later. I mean, judging by all the damning evidence that's building, my strong suggestion is that you beat bullion position by when it starts to occur. That's all for this week. As always, take great care of yourselves and those that you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.